With interest rates being higher than it's been since basically 2012, at one point getting into the eights, now back into the sixes, and in government cases, high fives, assumable mortgages have been a very popular route to go so that you could assume the rates that people might have gotten back in 2020, 2018, 2019, etc. But most people, including most loan officers, don't know what an assumable mortgage truly is and how to go about getting one. So let me do my best at explaining. Okay, so let's draw a house. You're welcome. Drawer of the year. And then let's say that they want to sell this home for, let's say, $400,000. Let's say that the mortgage rate that is tied to the current mortgage of the current home that they're trying to sell is 3%. And of course, we don't know how much they purchased it for or how much they owe on the balance, but let's just say that their mortgage payment is currently sitting at $1,200 a month, which is obviously a phenomenal mortgage payment. So in this fictitious scenario, what we're going to do to make numbers simple, we're going to say that they have $200,000 in equity in this house, and then they still owe, we'll say owe $200,000. Okay, so essentially they have a mortgage for half of what they want to sell it for. So if you're trying to purchase this home and you're saying, I want to assume that mortgage, what you're saying is you want to assume what they still owe, okay? They still owe $200,000. Now the mortgage payment is not based off of $200,000. The mortgage payment is based off of what their original balance was off of 3%, and that gave them that mortgage payment of $1,200. But whatever it started off as, it has been paid down to for $200,000. So what typically happens is if you want to purchase this home for the amount of $400,000, you can do that with an assumable mortgage. And what that means is you would assume the current mortgage of $200,000, okay? You'd assume this, but since they still want $400,000, you'd have to come in with cash for the remaining balance of $200,000 so that the seller can get what they want. And what you would get is what you want is a low interest rate tied to a low mortgage payment. And on top of that, probably, let's just say less years on the mortgage, You guys get it. Okay, so that's essentially the fast track for assumable mortgages. But let's get into more details and talk about things that you should know about doing these mortgages. I had to put on my glasses. First, know that not all loans are assumable, okay? Most conventional loans aren't assumable. Some are, very, very few are, but most aren't. And the reason for conventional loans not being assumable is because they have what they call a due on sale clause, meaning once the house is sold, the remaining balance is due at the sale of the close. I have heard of instances where conventional loans are assumable, but then when you call and ask how long will it take to get this assumable loan done, sometimes they say anywhere between 4 to 6 months. So take that for what it's worth. But what loans are typically almost always assumable? Government loans, FHA loans, VA loans, USDA loans. Almost all of those loans are assumable. And what that also means is if it's one of those three loans, it's also got to be a primary residence loan because you cannot purchase an FHA loan if it's not on your primary residence. So it can't be a second home, cannot be an investment home, etc. Also, something you need to know is you need the seller's permission. The seller needs to sign off on it. So if the property doesn't say assumable loan, and you want to still assume it, because most people don't know that their FHA loan is assumable, you want to get in direct contact with the listing agent and be very, very clear of your intentions. Another thing about assumable loans is you got to know that the banks make no money on this. They absolutely hate doing these assumable loans because it's a loss leader for them. So in many cases, the bank will actually send you a letter or straight deny you the opportunity of assuming the loan. They'll say we can't do it or we don't do it. The facts is that they have to do it if you want to do it because the rules state that you can and you will. So if that ends up happening, you might need to go up to upper management, show them some of the code and some of the guidelines and say you are, not whether you want to, but you are doing it. But that can lead up to making this a much longer process. Also, when working with this or working with assumable loans, know you're not going to be working with a mortgage loan officer. So what that means is you're going to be in the dark throughout the whole process. You're going to do what they ask, when they ask, hopefully in a timely manner, and just hope that it goes good. Don't expect for customer service. Don't expect for anything out of the ordinary. Just know that it is going to be purely transactional because the bank puts no money into this and doesn't want to do it in the first place. And listen, if you're a seller and you want to make your home more attractive and offer your assumable mortgage of 3-4% or whatnot, that's phenomenal. What you want to do is get ahead of the game, and you want to call your loan servicer and ask them for an assumable package. Okay, that assumable package should tell you everything as far as what to expect, what documents you need, the process. That's going to give you the idea and the framework on how to set up an assumable mortgage, or to set that up between the servicer and the buyer. So what are the positives when assuming a loan? Well, there are a couple, obviously, right? Or else nobody would do it. First, huge assumable is the low interest rate. That's the obvious, right? You're only doing this to obtain the low interest rate that the person has, and the low interest rate directly correlates to hopefully a lower mortgage payment. I mean, let's look at today. In the middle of June, late June 2025, my mortgage interest rate for FHA is in the high fives. I have to be vague because I can't. I'm not disclosing APR and everything else. But high fives, 5.99. Let's just say that. Doesn't matter really, because if you could assume a 3.5% mortgage, what does my fives mean anything? You want the obvious 3.5. So it makes those current mortgage rates on that current mortgage very, very attractive to so many potential buyers. Another thing is, if you do assume that rate, you are receiving essentially a huge discount. I mean, think about it. It's a huge discount to be able to get a mortgage at a market rate that you almost can't receive anywhere else. I mean, to get a 3.5% rate in today's rate environment, what's it going to cost? Over 20 grand just for the rate itself? Huge discount. And because the loan is already done and you're assuming a loan that was already approved and packaged pretty and in process, that means you're not going to need another appraisal. The appraisal is to figure out the value of the home. But what's it matter, the value of the home, if you're going to assume a mortgage? There's no appraisal needed. Now, all these are great reasons, but probably I'd say maybe the biggest reason is you assume the remainder of the years of the loan. So let's say they've been living in it for 10 years and now they have 20 years left on that loan. So you just attained not only a super low rate, probably a super low payment, but only 20 years left for that mortgage. That's phenomenal. That the upsides on obtaining assumable loans are through the roof. But obviously, if it sounds too good to be true, then it might be. And let's talk about some of the cons for that. The biggest con that we're going to see is the large down payment. I just gave you guys the example of somebody who, let's say they purchased the home at $300,000, right? And in my example, now they want to sell it for $400,000, but they only owe $200,000. So essentially, they're having to, if someone wanted to buy this home, they'd have to come in with $200,000 cash. Now, obviously, there are other creative ways of doing of financing a second mortgage into this at the same time, but it makes it even messier and it make the process even longer. Most buyers will not accept that extra headache and unknown, because you don't know until it is time to close if it's approved. So adding in a second mortgage to that throws a lot of wrenches in there. So the large down payment is definitely a deterrent and probably not available for most buyers. Another huge downfall is banks can take a long time to get these things from start to actually closed, to finished. And the reason again is because there's no money in it for the bank, so they don't put that in front of the line. As a matter of fact, you're not going to be put in front of any line where there's money to be made and no money to be made. So just do know that FHA does have a timetable for them. Like they say from the time that it's in sent into underwriting until from the time the process is started to the time they receive what we call a final approval from the underwriter has got to be 45 days. So that's great. However long it takes for loan docs to go out, well, first for setup, then loan docs, then signatures, and then loan setup again, and then finally into underwriting, who knows how long that'll take. It could take, for some mortgage brokers like myself, it could take 1 day. For those banks, it might take 2 weeks. And then you got the 45 days. It shouldn't take that long, but they have up to that long. And then once they're finally approved, who's to say it might not take another week to get the loan docs, get everything redone, sent out? That can be a long time. VA doesn't even have a time limit. So there's also that. Now, let me premise that, in my opinion, loans aren't that hard. So if you package your loan properly and you submit a super clean package to the bank, it should not take 45 days. You could literally do it in 30 days. In this scenario, you're going to hope that your realtor has a super strong bond with the loan officer, and maybe the loan officer will do some pro bono work to help make sure it's a very, very clean file so that you can close it in 30 days, because I have heard of that happening on multiple occasions. Another con is if you're assuming an FHA loan prior to 2013, it won't matter in most cases, not all, but probably in most cases, probably 90+% of the cases, it won't matter how much you owe compared to how much the value is to knock off the mortgage insurance. Because mortgage insurance typically gets knocked off once it's either, typically through attrition, it'll be 78% of the loan to value. So if you pay down the mortgage 78%, you have 22% equity. Typically, mortgage insurance falls off on conventional loans, not on FHA. FHA, unless you put 10% down at the time of purchase, you're going to have, unless you've done that, you're going to have mortgage insurance for the life of the loan on that FHA loan. No way to get rid of it, regardless of the balance. Another con, like I mentioned earlier, because you're not working with the mortgage loan officer, you're not going to have any insider information as to what's going on with your loan. They're going to email you maybe, or maybe give you a call, who knows, and then you're going to respond back, and that you're just going to hope and pray. Hope and pray that whatever they're doing, that they even got it, that they're even doing something on that loan. Who's to say that they don't miss it? You just won't be able to call a loan officer and say, hey, where's my loan at in the process? And typically, if you do that in a regular traditional loan, the loan officer will make a couple phone calls. They'll find out. They'll give you an ETA on what to expect next. Gonna get none of that with regards to this process. And what makes that so bad on the sellers, because they're also wondering and hoping and praying that this gets approved, right? So a lot of sellers don't like that uncertainty, and a lot of sellers don't care if you assume their mortgage or not. They just want the $200,000 in equity. So a lot of sellers will say, I don't want the headache. No, we want regular traditional financing. Which makes this another con. And probably another con on the VA side, if you see a VA loan that has a super low rate and you're not a veteran, you're most likely not going to be able to take advantage of assuming that loan. Typically, it goes from VA, from veteran to veteran, because there's what we call entitlement. Every time you use your VA loan, and if the current veteran decides to sell to a non-veteran, the VA entitlement sticks with that property. And now the current veteran who just sold that home, part of their entitlement stays with that house because the person buying it is not a veteran, which means when the veteran goes to buy another home, they will have less entitlement, which means they will be able to qualify for less amount home because part of their qualification amount in total is tied up with the other home. Meaning, basically, if you're not a veteran, don't look at VA assumables, because the chances are there's no way I would let my VA entitlement to go to some stranger and then let them foreclose on me later on in the future. Meaning that would hurt my VA entitlement if they decided to not make their mortgage payment. Not even taking that chance. With that being said, there are definitely positives and negatives. There are definitely hurdles you got to jump, because anything that is too good to be true is. So this isn't too good to be true, because you're going to have to put a large down payment. You got to do a lot of stuff that we just said in the video. But if you can do it and all the stars align, I congratulate you on your new home purchase with your assumable loan.